Welcome everybody. Today we'll discuss the top 10 sustainable ETFs that you should know about. Now let's jump right into it. Now what even is an ETF? An ETF allows you to invest into thousands of companies at the same time. It's basically you're buying like a type of stock, which basically encapsulates not just one company, but hundreds or even thousands of companies at the same time. Like imagine you're going to a market and you're going to go and buy some fruit, right? And you normally go and buy an apple, and then you have the apple and you eat it, and you're healthy and it's all good. But an ETF allows you basically to go out there and buy a basket of different fruits, right? You might go and get an apple, you might get a banana, you might get a kiwi, you might get an avocado, or avocado is not a fruit, but you get my point, right? You get a bunch of different ones. It's better for your body, it's better for your health, because now you're getting different vitamins that you might not have gotten with just the apple. So, with an ETF, it's somewhat similar. Instead of one company, you're buying one stock of one company. Now you're buying a pool of stocks from different companies, which means you are diversified. If one company in this ETF goes bankrupt, your value of the ETF might go down a little bit, but in the long run, all the companies that are doing really well will lead to increasing price over time. And whereas if you just bought that single stock goes bankrupt, all your money out the window, in the toilet, whatever, it's gone. And that's what an ETF helps you to mitigate your risks that way. So they typically display a type of index. Like for example, there's an S&P 500 index, which tracks the top 500 companies that are traded in the United States, right? So it's pretty big companies that are doing really well, and you put your money in there, leave it there, it will grow in value over time, because these companies, they're damn big, they grow, and so will your investment. And these typically come with, so these ETFs, they come with a fee that you have to pay. It's a very small fee, it's a management fee of about 0.05 or 0.7% per year, which is not really a lot, but it might impact your choice in which ETF you choose, because some might be a bit higher, some might be a bit lower, you don't know. So you would have to do your research beforehand. And there's, for example, like the thematic investing, or there is exclusionary investing, where you basically can either like thematically invest into a certain theme that you really like for example, renewable energies, or you could invest into semiconductors, or you could invest into recycling technologies or hydrogen, all types of future activities. Because when it comes to sustainable investing, you can look at things that not just create immediate like the sustainability, but also maybe the technologies that contribute towards a more sustainable world. So not into sustainability directly per se, like for example, clean technologies might be an obvious one, but maybe semiconductors allowing you to create more sophisticated, say, EV technology that then can create better alternatives to the normal petrol car that you would drive, right? So this would be an example. I don't know if it's technically correct, but you know what I mean. Like you need these technologies, but they can be used for good and bad things. So you kind of have to form a bit of a understanding around what it is that you want to support in order to invest sustainably per se. Then there's also exclusionary investing, right? Exclusionary investing allows you to exclude certain industries from your portfolio through sustainable investing options that exist, right? So for example, maybe you say you definitely do want to invest into things other than, fossil fuels, maybe tobacco, maybe alcohol, maybe the defense industry, maybe genetically modified organisms, palm oil, all these different things. And there's different funds that allow you to do that. It's a really effective way to passively invest, to basically put your money into it and just let it sit there. Don't worry about it. Leave it there for years and it will grow over time. To show you, here is a graph of different types of sustainable investing products that exclude different things depending on certain industries that you may or may not morally support. So you can therefore choose to exclude certain activities from your portfolio. Note though that when you look at these ETFs, you should actually check what holdings they have, like what companies they actually invest in, and look in the fine print if you're really interested in this, because sometimes even though they exclude certain things, like you might not 100% agree, because it's hard to distinguish between is it unsustainable if it like contributes to an industry, like where do you draw the line? If someone produces parts for a fossil fuel extraction company and the company itself doesn't extract the fossil fuels but it builds the infrastructure for it, is that considered unsustainable? It's really hard to draw the line. Like there's car companies that build parts for the defense industry, right? Like, would you exclude that car company because it builds these one parts, although normally they just build cars, right? So you have to kind of consider what you consider is moral. All right, so the first ETF that we go through today is the iShares MSCI USA ESG Enhanced ETF. This is an ETF that is exclusionary, and it excludes these industries that we've shown here before, including like weapons, thermal coal, and tobacco. So it excludes those things. It comes at a very low fee tier of 0.7% per annum, which is really low. It is distributing, meaning that sometimes companies pay out profits to shareholders, and in this case it will distribute it, so you will receive money into your trading account whenever these dividends are being paid out. So these profits that are being paid out to shareholders. It has a really large fund size and has 530 holdings, very diversified, and it grew by 106% over the last 5 years, which is quite significant. And since the inception in 2019, it has been basically formed in 2019, so it has been there for a while, is quite established, so that's a good sign. And 96% US companies, so very much based in the US. I mean, it is a USA ETF after all. All right, so the next ETF that we'll be discussing is the iShares MSCI World SRI ETF. So this is an ETF that has been growing by about 80% over the past 5 years, established in 2017. So it's been established for a couple of years. Mostly United States companies, 65%, 7% Japan, 3.5% Canada. It has a 0.2% fee tier, so 0.2% is the management fee for this ETF. You have it accumulating, so this means that the dividends or the profits being paid out to shareholders are being automatically reinvested into this ETF. It has a really large fund size, and it has 402 different company holdings. So it excludes certain industries. As we pointed out here before, this is the SRI, so it excludes slightly more than the ESG enhanced ETF, and therefore, or the ESG screened as well, and therefore is more, I guess, rigorous in terms of its sustainability criteria. But I would still recommend to have a look through the holdings to actually see, whether you agree with some of the companies that are in there, because it has these criteria, but it pays off if you really care about the sustainability aspect to have a look, what are the actual holdings. So next up we have a thematic ETF. This is the Amundi MSCI Semiconductors ESG Screened ETF. So it has the ESG screening criteria that we've talked about, so an exclusionary, but it's thematic to the semiconductor industry, so investing into semiconductor companies. Now this ETF has been going absolutely crazy over the past 5 years, having grown by 227%, which is really big. And it has existed since 2007, so quite an established ETF, having grown considerably over its time since its inception. And it's mostly United States companies, 69%. We've got 16% Taiwan and 6.5% Netherlands. And we have a fee tier of 0.35, so a slightly higher fee tier. But considering its insane growth wouldn't make a substantial difference there. So it's accumulating, which means that dividends are being reinvested automatically we have 66 holdings, so it's significantly less diversified, which is to be aware of. So considering it, the others had 402, this one was 66. Not that many companies, but insane growth. So, and then we're going to blend in again the exclusion criteria for you to be aware of. In terms of looking at what kind of industries are excluded, but once again have a look at the company lists that are there as well. So this one will include conventional weapons, and therefore could be that there's some semiconductor companies that are involved in conventional weapons. So if this is something that you are okay with, then you could consider investing in this ETF. Next up, we have the iShares MSCI Emerging Market Socially Responsible ETF. And over the past 5 years, it has seen a growth rate of 10.47%, which is not that much if you think about it. But because the emerging market space, in this case considering China, India, and other countries, are going to experience significant growth in the future. So this could be a really good one in the long term. Also, don't ask me why it's called emerging markets. In many ways, India and China, for example, are countries that are well advanced in many fields than, the quote developed world, according to this. So don't ask me why. But in any case, we basically have a 0.25% fee tier. It's accumulating 223 holdings. Mostly Taiwan, India, China, and South Korea involved in this. And we have, a big holding in the Taiwan Semiconductors Manufacturing Company. So, biggest player in the semiconductor space, and some other companies there. So this could be a good one to have a look at, and has that slightly more stringent sustainability criteria we talked about before. Next up, we have the iShares S&P 500 Paris-Aligned Climate ETF. We basically have another kind of exclusionary ETF, which excludes a lot on the fossil fuel space as well as the arms space. We have basically a growth rate of 122% over the past 5 years. It is an accumulating ETF. Large fund size, 301 holdings is pretty big. The inception has only been since 2021. And, this could potentially be a problem if you're looking for something that's more established, more already, having grown over a longer time horizon, and evidently grown over a longer time horizon. So this could be something that you might not like, because it doesn't mean that it will not grow in the future. It just means that it hasn't been established for that long, which you could be fine about. But for some other people, it might be a problem if it could be considered more unsafe in that way. Then there's another thematic ETF, which is basically the Xtrackers Future Mobility ETF, which is about basically progressing the sustainable transport sector in terms of electric mobilization going forward. It's grown by 83% or 84% over the past 5 years. It has a fee tier of 0.35% accumulating, and only has 69 holdings, so slightly less diversified. Still a lot of companies, but slightly less. So this could be something to have a look out for. The top 10 holdings are Tesla, Nvidia, and then there's Hitachi, Meta Platforms, Analog Devices, Alphabet, General Motors, Qualcomm, and Toyota. We have the countries that are most relevant being the United States and Japan, as well as Germany. This is a pretty good fund in terms of its country diversity, because it also has a significant portion in Japan and in Germany, while also obviously the main holder being the United States still. It could be good to have this one if you were looking for some more country diversity as well. So the fund has only existed since 2019, so it's been there for about 5 years, displayed significant growth since then, which is 5 years isn't that little either, so it's not too bad. But yes, would definitely do some more research as well and look into the holdings in more detail and the sustainability criteria. So the next fund is the iShares MSCI World Quality Dividend ESG ETF. This one has a growth since the max of about 71.79% with 0.38% fee tier. It has 177 holdings and is distributing. So you get dividends of about 2.5% per annum, which are distributed into your account every year. And it invests into basically companies that have displayed sustainability criteria of exclusion of certain industries, which we'll get to in a moment. And it basically tries to invest into companies that share a lot of its profits with its stakeholders, shareholders that you can profit from. So the fund has existed since 2020, so it has been there for a few years, and it excludes controversial weapons, nuclear weapons, conventional weapons, civilian firearms, tobacco, oil sands, and thermal coal. So it has a 2.5% dividend yield, as said, and it's good to make some passive income if you're looking for that extra cash flow and you have some cash sitting on the side. This could be a safe way to put your money to work and allow you to invest and get some cash every year paid into your account. Well, I think the profits are probably paid twice a year. Right, next up we have the SPDR S&P 500 ESG Leaders ETF. And so this has experienced growth of 122% over the last 5 years. It includes 208 companies, 0.3% fee tier, really low fees. So this could be really good. It's accumulating, so reinvestment of dividends. So its inception has been in December 2019, so it's been around for a while. And it excludes certain industries, and it does not, for example, exclude unconventional oil and gas extraction. So you will be able to find some oil and gas companies in there. So given that you are okay with that, as well as with thermal coal that is being mined, you could be investing into this fund potentially. So in any case, it makes sense to have a look at the holdings and see if there's any companies that you just morally disagree with in terms of what they do, and then you can align your money with your values that way, basically looking to make a profit of things that you morally support. Next up, we have the AppMundi MSCI Robotics and AI ESG Screened ETF. 88.3% growth over the last 5 years, 0.4% fee tier, 162 holdings accumulating, and it has mostly US-based companies, some Japan as well. You have a wide range of different companies in the robotics and AI space. Growing fields. The world is investing billions into this. And it's only an emerging field, so a lot of opportunity going forward, and some sustainability criteria, ESG screened, as we see on the side, and you can therefore invest your money and into future tech while being sustainable at the same time. All right, now the last fund that we have for you today is the SPDR Stocks Europe 600 SRI UCITS ETF. And this has grown by 43% over the past 5 years. Inception has been in 2019. It has 200 different companies in it. It is accumulating, so reinvesting of profits, of dividends, and it has 0.12% fee tier. We can see that this one is actually quite stringent in terms of its exclusions. It doesn't exclude genetically modified organisms, but it very much excludes everything else. So this could be good if you're really looking to be more sustainable, but also comes at a cost with a little less growth over the past 5 years. So if this is something that you are okay with absorbing, you might want to consider buying this ETF if you're looking to invest. The main countries that it invests in are Germany, Switzerland, France, United Kingdom, and has different companies involved in this. So this could be really good for you if you're looking to be involved in these sectors. So thank you for tuning in today. So once again, I would definitely have a look at the different critiques that exist. ESG investing is not without its critiques, but you can really make a lot of money in this space and invest towards better things for the future. But do your own research. Don't just buy these stocks because I show them to you. I'm not a financial advisor. I can't give you any financial advice, and I can't tell you to buy any stocks and recommend them. So do your own research, look at the holdings, look at the growth, look at criteria, and educate yourself financially further.